underwriting, let me come to that.
Yeah.
Right? That's something that your regulator has constantly been saying, listen, the growth is too high, so tighten your underwriting. Raised risk weights, then constantly advising banks and other lenders to look at this. You've done something on the underwriting side. That will be the next question. But for now, how are you seeing underwriting in the ecosystem? Do you think that the market is playing it a little fast and loose?
See, what happens is that, and I've been around in sort of the asset side and the lending side of the business for like over 25 years now. Right. So, and I've seen good days, I've seen bad days, right? One of the things I can tell you that, when we saw the, aftermath of the global financial crisis around 2008 to 2010, when many of the large lenders in the country were impacted by sort of a credit crisis, the underwriting standards that existed at that point in time and the underwriting standards that exist right now, there's a heaven and hell difference, right?
Okay.
For example, taking full income into consideration or taking imputed income into consideration, trying to see whether you are taking all the leverage equations into consideration, whether you're looking at, maximum unsecured exposure or what you call MUB or ADB, aggregate debt burden, or FOIR, as many of the other sort of nomenclatures of that particular things go. I think this is ingrained into most players in the business. So, in terms of, I think, the overall quality of the assets in the market and overall health of the sort of the retail assets in the market, I would say that it is fairly well administered. And the stress testing of the quality of underwriting and the quality of sort of asset buildup in the country was done during COVID. Right? And COVID went into crippling disruption between 2010 and 2022. And frankly, losses were elevated. People took provisions, people took preemptive provisions, people took overlays. But the fact is that no organization came to a precipice saying that, because of credit losses, we have dangers of being seizing as a going concern. Right? So I think that was the first acid test. So I would like to say that, yes, things are stable. However, I also do believe that, risk always comes from areas where, are blind spots.
Correct.
Right? And there has been quite robust lending in the country, but there has been, in certain pockets, there has been a little bit of, I would call, overcrowding of lending, right? The places where there has been overcrowding of lending, especially say in the unsecured space, credit cards because of some structural reasons, personal loans because small ticket personal loans on the lower end of the spectrum were done with what is quote unquote called algorithmic lending, etc., and all that stuff, right? Some of those are seeing risk on the margins, right? And it will continue to play out for some time. However, I'd like to qualify my statement that is it something which is widespread and pervasive and will pose as a threat to the system? Whatever data is available with me right now, I don't think it's that. It will be some risk on the margins. There is talk of some of this lending on into the markets, etc., where people have borrowed to leverage themselves in the equity market. It always happens on the margin, right? I think the regulator is pushing on lenders to a certain end use, and I think it's also a step in the right direction, right? So I do believe that the ecosystem is strong and stable. There is some risk on the margin which might play out, but overall the structure is safe.